Hello, everyone. If you are first time here, so welcome. My name is Kay Wittmann. I am a DSCR Queens. Basically, DSCR is when you buy rental properties and using DSCR loan to fund deals. DSCR loan using a property income instead of your income to justify for the loan. So today, I'm going to show you the deal analyzer that I designed based on my experience as a real estate investor, lenders. And these two, it simplified the process, how you analyze the deal and make you focus what exactly you need to looking at first or after. You don't overwhelm with information with all spreadsheet with all information all at once. You know exactly that you should pursue this deal or not. I'm gonna walk you through this DSCR deals, and I also will have a link below that you can download this for free. Okay. All right. So first here, this analyzer is designed for 1 to 4 units, small multifamily. Anything over than 4 units technically fall under commercial loan, commercial rules, guideline difference. For this DSCR loan that designed specifically for small multifamily residential guideline. So I just want to be clear, this is number one. First section, the property detail. Okay. You put the address, year built, square footage, square feet. It's very important here in square feet is living space, okay? It's not including attached garage. And first thing that you want to know to do DSCR deal is you want to know what your mortgage income, what your mortgage payment is, and then what your income is. And that's how you find out DSCR ratio is. So the first thing first, what's the mortgage payment would be? Let's say you put 38 $380,000 purchase price, interest is 7%. If you want to know the interest is as of today, I also have the link below as well that you can add into my weekly interest rate, DSCR interest rate, to inform you what's the rates that look like and what's DSCR deals. Okay, and I'll move on to the next down payment. If you are good credit over the 700, you can down to 20%. The minimum down payment for DSCR is 20%. Long term, I leave it 30%. Insurance, let's say this is have to be a local market. You have to know your insurance in your market. For 1 unit, 2 unit, 3 unit, 4 unit, you should have your insurance, people that you're dealing with, ask them what is this market. The insurance would be for how many units. Property tax, the same thing. You need to know your tax rate. And this is a post-sale basis, okay? Meaning after your purchase price, not the current value assessment. So let's see this one, 4,200 HOA. You can get it from realtor, or you can just glance quickly doing research. If you list on Zillow, oftentimes they put in bottom this show how many do they have HOA or not. For example, this one, we have the monthly mortgage is $2,523. And what's the DSCR loan? Let's say this one is duplex only. So that's a rental income is $2,550. You have to know your market. So you know that your market in that condition that look like, decent, or it was kind of torn down. Maybe the market rent is lower than 1,200, or if you just fix up, upgrades, so maybe it could be 1,350, depends, that's why it's very important. You have to know your market. Monthly income at first, you might not know, just leave it 0. Okay. So we come down to actually the ratio 0.97. So this yellow color telling you basically be careful. DSCR minimum ratio is 1%. Okay, the realtor and probably not very know at this point, what kind of loan you're gonna go for. You don't really have to tell them, I'm gonna use DSCR loan, I'm gonna use conventional. That's too much information at first when you want to invest in deal. They do not need to know what type of loan that you need to lend, but you need to understand, if you want to use DSCR loan, okay, these price, the income that you're looking for. For this case, below than 1, so yellow, operating expenses. This section is the lender don't look at, but you as an investor, you should. Okay, vacancy allowance, what is your market? Even though it's full, you should put 5%. Property management, even you have to know your market. You should have the good property management that you can trust. If you manage yourself, you should put the property management, if for my case, property that I manage myself, mine, still put 5% maintenance. The roof fund is, even though minimum, I still put about 10, the class that I'm buying about B and C, so I'll leave it 5. 5, or let's say middle 7. Okay, cap rate reserve, you can put 10%. Now this is all expenses. You don't know, you can't just leave it. So that's annual expenses. Okay, 7,938. Your NOI, okay, 23,400. At 29,400 annual expenses above of here. So your NOI is 21,462. Now the cap rate section, the cash flow. Now your cap rate is automatically populated. You don't really need to put anything in here. All you need is just punch a number out here. So the cash to close. So if you're buying, usually the closing costs, the loan and everything, that's round about 3% of your buying price. Rehab budget, if you don't really need to put anything, let's say this one you don't, you just leave it 0. So you know that actually now you need to have cash with the down payment, the closing costs and everything's about $87,400. Cash, on cash returns based on the cash flow above is actually negative. This is not a very good deal already. So if you want to continue doing this part is something that you should not be too optimistic. Always be conservative in this part. For me, I put 1% rent growth, expensive growth, annual appreciation. I put 1 cost of sales, 5%. And then if you know the rent control in that area, then just click here. It's just all, if you don't already have earthquake, take it out. Okay, so this deal is like, like not quite this great deal. There's no cash flow here. So if you want to offer, okay, based on your cash flow DSCR, so you offer 3,600, but if based on cap rates, so here, so it's kind of middle. So let's say I'm go back here. Okay, I'm gonna offer 330. Okay, so let's see how my number look like. Okay, it's over than 1. DSCR is good, so that meet lender requirement. And OI, and I have cap rate 6.5, which is not bad. Okay. And cash flow still negative. Okay. But again, this is paper cash flow. Okay. If you want to know exactly cash flow, that you generated, cash, like handy cash, not the people lost. You can take vacancy allowance out. You can take maintenance, and you can take CapEx reserve out, but leave property management and maintenance just to be conservative, because those are real expenses, not the people lost. Okay. All right. So now, okay, so this deal is not quite, But you're gonna have to negotiate, based on this price, 380, but probably if they're gonna do with 315, that's will be kind of the kind of deal that's cap rate. Yeah. Yeah, this is max based on your cash on cash return. Okay, if you cash on cash, target cash on cash 15% and minimum the cap rate here. You want your cash, to generate cash flow. In this case, the cash flow is not quite. So that's why. But if it's in the area that I actually would appreciate very well, this deal is not too bad. So I just want to show you quickly how this deal analysis work. Okay. And I'll put a link below that you can download for free. Okay. So for today, that's it for now. I'm clock out. Bye everyone.